Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. With me, my good friend and special guest, Dr. Friday with Dr. Friday's tax and financial firm over in Brentwood, Tennessee. You know, when it comes to taxes, this is one of those areas I know there's tax software. I know people, like to go to some of these services. Right. That's right. I got to tell you, I've run into more problems where clients have done that, use tax software, and then come in and I'm trying to fix problems that they, sometimes.
Well, the problem is they're asking questions that sometimes people don't really know the answer, or maybe they're not totally understanding the question, and so they're making a good guess, but the problem is you can't really guess when it comes to something. I mean, I'm the first one to say, if you've got a W-2 and that's all you have, or maybe some mortgage interest, especially coming in 2018, W-2, you're not really needing a tax expert. You have rental properties though, if you're buying and selling stocks, you want to make sure those are done correctly, because those are going to be a little bit different than your normal tax form. So there is a purpose for it, but many times we find where people either have lost carry forwards because they didn't know about it, because they did it themselves, or they've just put it on the wrong type of form, or not taken the right amount, somehow overriding the system and getting more than we think they should have gotten in some of the cases. So, and the IRS usually agrees with us, so that usually means you owe money plus penalties, so that's when it becomes an expensive situation.
And knowing what to look for on your tax forms, this is one of those areas, with my clients that work with Dr. Friday as well, and I got quite a few, so we set aside typically 3 or 4 days out of the year.
6, 7.
Where we some days that we'll just meet with my clients on those days, and we'll just set all that and we'll schedule it with the clients. And so we typically, I think on days like that, would get 12 to maybe 15 clients a day in on that.
Long day.
When we're doing those though, I'm seeing the tax forms as well. And I know some of the things, if we've done Roth conversions, if we've just had distributions that have come out of an IRA for income purposes, any of those things we're checking, we're doing withholding when we're doing those. So we're making sure that the right numbers are in the right boxes here. And every year we have typically, some number of, 5 or 6 at least of errors that we see on these forms from the custodians. Easy enough to correct, but it's so much easier. A lot of times I'm able to correct those right there on the spot.
Absolutely.
We see the error, I contact the custodian, we get the corrected form, and we're able to still get the forms filed on time without any worry. If you don't know though, and you're sitting there at your computer and you just see here's what it says and that's what you put in, and it's an error, guess what? You're going to eventually, at some point, the IRS is going to see this mismatch. They're going to send you a letter, and you're going to be back to the custodian, and it's going to take a lot longer. You're going to have a lot more work involved. You're going to have to, of course, deal with the IRS in the part of the process, and the custodian and getting those things fixed. So this is one of those areas that I just, for what? To save 50 bucks?
Yeah.
What's the point? I don't get it.
Well, and
my time is way more valuable than that.
And I think, because a lot of times the people that walk into my office after tax season, they've received the love letter, they've either overrode the system, maybe it was a code 1 saying early withdrawal from a Roth or whatever, but they said, no, it wasn't. It should have been a code 7. They put in code 7 because that's what they think it should be, but the IRS is still seeing code 1. We're getting it fixed before the IRS gets the paperwork, where if you wait, and then it's a lot more work because the IRS does not move very quickly when it comes to correction. Stock basis, a lot of times I'll get 1099Bs and they will not have the basis. Hank can go back, track it down for me, get me the information, and then we have the right information to submit to the government, so we don't have to worry about the government trying to create their own numbers on our behalf. They don't have any information, so they're dealing with zeros unless you tell them otherwise.
And this is one of those areas. Keep in mind, it's only been a few years that custodians have been required to track cost basis when it comes to stocks and retirement accounts and that. So prior to that, they might do a guess for you. They may not even do that. If you don't then report and have tracked your cost basis, or at least be able to know, and and I've done this every year for at least for a handful of clients, I would say it tends to happen where we're tracking cost basis or going back and determining what cost basis was based on what their purchase history was, what the stock did over time, all those kind of things. It's lengthy, it's tedious, but if you don't do it, guess what? The IRS says, well, if you don't put in basis, it must be zero,
right.
and therefore the whole thing becomes taxable. And we've seen that happen. I mean, this isn't, you know, where I had a client call me one year where she had sold some stock and she didn't, now this was unknown to me. She had done this on a brokerage account. I wasn't aware. She ended up with a capital gain. She didn't, when she filed her taxes, she didn't put it in there. And so the IRS sent her, yeah, they corrected her return, and guess what? You owe us, you know, I can't remember now, I think it was $15,000 or something more than she thought. And she called me up, what happened? And we got it fixed. We, you know, filed the right form, and was it 5498, I think, or something? I can't remember.
Right, well, we had to change that in the 1040X. Obviously, we had to file so that the IRS had the information. But in 2018, they've also changed the law where it used to be LIFO, where you took the last in, first out, last in, last out, excuse me. The law has now changed in 18 where they want the first in, first out for stock evaluations or for your cost basis. And that, I think, has a lot to do with the cryptocurrency and things that's coming through more than probably some of the ordinary tax people, because they've always tracked stock for stock, but it's a whole new world out there for that. And then RMDs, that's another big one. Hank has many times found someone that hadn't been taking their RMDs, and required minimum distributions are huge. If you do not pay the withdraw it, the penalty is 50% of whatever it was. So if you didn't take out $2,000, the government is looking for $1,000 penalty, period. But there are some ways that we've been very, very fortunate in trying to deal with that issue with the IRS so far. So being proactive in those situations has been a benefit to us. But you know, if you don't know,
catch it, that's the key. If someone comes in and I'm going through and I say, wait a minute, I don't see this RMD part. So and easy enough, when I do an analysis, you know, we haven't even done that. First 10 callers. Day is flying by.
Friday the 13th. What can we say?
All right, there we go again. First 10 callers to my office, and we'll talk a little bit about how this works for you. First 10 callers to my office, 615-376-5325. We'll do up a free retirement income analysis. It includes a lot of this tax planning we're talking about. That's included in this analysis. We're doing a comprehensive financial plan that includes tax planning, estate planning, investment analysis, all of it. We're going to show you what your financial future looks like based on the things you're doing, and then show you ways that you can improve it and make it better. Show you ways that you can improve your returns, ways that you can reduce your risk, your volatility, all of that. First 10 callers, 615-376-5325. Tessa's standing by. She'll get your information, send you out a packet of with a checklist of things to bring to your appointment with me, and we'll do up a comprehensive plan. Again, no charge, whether it's 1 visit, 2 visits, 3, but whatever it takes, okay? I want you to have something that you can really use, and when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. And Chapter 3, IRA Mastery, gets into a lot of the tax planning strategies that we're talking about here today. Required minimum distributions, this is one of those. So a new client comes in, I'm doing this analysis for them, right? I look at their tax return and I'm looking at their you know, the age, they're over 70 and a half, that's when you have to start taking them. So they're over 70 and a half, and on the tax return I'm not seeing this deduction. Where's the you know, IRA distribution showing this required minimum distribution was taken? What required minimum distribution?
Exactly.
They didn't do it. All right, and the custodians, most custodians try to send out letters on these to remind you, guess what, you're 70 and a half, you have to take this now, or you're required by the blah, blah, blah. There again, if it doesn't mean they're required to, and they don't have any responsibility to the IRS for the payment of those, it's still on you to make sure that gets done. So if you didn't get the letter, or you say, what's this letter? Oh, I don't know, junk mail. And we throw it away. So it's real important. As Friday just said, that's a 50% penalty, and you know, 2,000, and you know, think about this: you got $500,000 sitting in in an IRA, and you didn't 4%? Do your 401k. By the way, that's the other thing. All retirement accounts, and I'm going to give you an exception to this rule. All retirement accounts at 70 and a half, if you're not working, okay, you have to take that out. Now if you got $500,000, that's going to be about $20,000 that you're supposed to take out in a required minimum distribution. You're at 50% penalty, 10 grand. Ouch. We don't want that. If the IRS finds it, if you don't do that and they find that, guess what? Chances of getting them to forgive that is like slim to none. All right, but if we're proactive, so when someone comes in and I see that, it's like, ooh, ouch, we got to do something real quick. So we can't do anything about it. We can't go back and fix it that way, but we can take it out in that year. We can let the IRS know we did take it out, and when we file the taxes that year, we notify them that we did. We notify them that it meets the requirements for all these other years that maybe we didn't take it, hopefully not lots
Too many
of years. and then so far, you know, fortunately, when you fix it yourself and you send in a letter and you say, I've corrected this so it'll never happen again, so far we haven't gotten hit with penalty. Hopefully that continues in that regard. Right. But again, it's so important to catch that and to do it right. Now, one exception to the RMD rule: if you are still working at an employer's where you have a 401k or retirement account, if you're still employed past 70 and a half, you can delay taking that required minimum distribution from that, only from that account. If you have other IRAs or 401ks from previous employers, you would still have to take the required minimum distribution on those, but on the one in which you're working, you can delay until you retire. Now, when you retire, you have to immediately take that RMD that year.
Can you contribute still?
And that's another. When you're working past 70 and a half, yes, you can still contribute to your 401k. Because you're not taking anything out. Now, the other part, Roth IRAs as well. There's not a, you don't have the time limit. So at 70 and a half on traditional IRAs, you can no longer contribute to those, whether you have income or not. But on Roth IRAs, you can.
Even if you're 70 and a half and working, can you still contribute to a Roth IRA?
Yes. Well, you'd have to be. In fact, if you're not working, yeah, you got to have earnings. Yes.
Okay.
But if you're working and you meet the other guidelines as far as their income cap outs and things like that, but beyond that, yes, you could.
And can you match for the spouse?
And yes, spouse would be the same.
I mean, assuming there's enough income and all the exceptions to that. Okay.
Yep.
I didn't know that. Well, I may have known that, but I forgot that.
So this is one of the things. This is one of the areas when we're looking at doing tax planning and when I meet with clients and we do all this and getting their plan initially set up, and then when we do the reviews, because I meet with clients typically twice a year, so we can do tax planning and we can do the financial planning, making sure we're staying on track, and of course checking in to make sure the investments are doing what we expect out of them. All of those things are part of a good review, and you want to have regular reviews. And in fact, I'm going to talk about this review process and how it works, and when Friday many times will come in to help me with doing planning. In fact, we may even talk about a couple of cases we're working on right now. But first, we're going to take a break. Join us here. We'll be right back on the Retirement Report.
Business owners, are you doing your own bookkeeping? G'day, I'm Dr.